Hello, friends. Welcome to Dirty Economics preview of Yellen Speech scheduled later today at the Jackson Hole Symposium. This is a much hyped event, and it usually is every year in August end. Markets somehow, each year speculate that Fed president would give a major hint at the next move in the monetary policy. And this time around, the speculation has gathered pace. Surprisingly, that Yellen might drop a hawkish bomb, in a sense that she might just hint at a rate hike, December rate hike, or basically, markets are expecting Yellen to be hawkish. So what we are going to do is we'll just look at the expectations surrounding the event, how markets have positioned themselves, and what kind of a trading opportunities are out there once Yellen's comments start hitting the wires. What to expect. First thing is that speculation has somehow gathered pace in the run-up to Jackson Hole event that Yellen would drop a rate hike hint. I say somehow because right at the start of the year, Fed was calling for 4 rate hikes this year, and slowly it has backtracked on its forward guidance. As of now, markets do not actually see any possibility of a rate hike in 2016. Even the 2017 rate hike plans are being questioned by the markets. But still, if you look at the precious metals, gold and silver, in the run-up to Jackson Hole event, gold has dropped. It has deflated back to 1320 levels from 1350, 1360. We have also had correction in silver, and precious metals pack is usually most sensitive to talk of rate hike, and this forces us to believe that maybe markets are positioned for a rate hike hint. That doesn't sound justified, because we have US elections in one month or so, and despite the strong data so far, Fed has really, what Fed has done throughout this year is just backtrack from its December forward guidance, which called for 4 more rate hikes in 2016, and we haven't had even one yet. So let's say if the market expectations are right. The second thing is, as I said, it's stuck between rock and hard place, because it cannot, Fed would not risk rocking the boat just a month ahead of elections, and at the same time, it cannot completely take a U-turn from its uh, forward guidance of policy tightening. Yes, Fed has already backtracked over its forward guidance of December, which said it's called for 4 more rate hikes this year, but it cannot completely come out massively dovish as well. So it's really stuck. And so far in the markets, if you just purely go by the technical charts, there are a lot of confusing signals out there, and so it's very difficult to judge how markets have really positioned themselves. And we'll be taking a look at the charts, and I shall describe the possible trading opportunities. So let's go on to the technical charts. So let me begin with AUD US. Let me begin with GBP USD pair. This is so what we have right now on the daily chart over here is I have a triangle formation on the daily chart following a sharp Brexit day retreat. And as you can see, the bird is having a tough time breaching the symmetrical triangle resistance. It tried once on August the 24th, and then August the 25th. It made another attempt today, and now it's hovering around 1.32 levels. Now, this one look at this chart, and you might just think that it's time to sell the British pound. And however, if you switch on to the hourly chart, the picture looks somewhat encouraging, because we have a rising trend line which has been acting as a strong support. It acted as a strong support yesterday. We bounced off from the rising trend line support yesterday, which was around 1.30 and 70, made a high of around 1.30 to 33 today. And uh, once again, as we can see, we have posted intraday lows below the rising trend line, but the hourly closing, so far the pair has managed to stay above the trend line on hourly closing basis. And that is what forces me to think that the odds of a bullish break are still intact. So if we do see a pair breaking above the triangle resistance, I think it's a good point to enter long trades. And such a break appears very likely if the Fed stays neutral, and that is what we expect, that Fed Yellen is likely to stay neutral. It's likely to stay reiterate its data dependent stance, and that would be read by markets as dovish, especially because uh, the markets have position for some kind of a hawkish talk. So even the neutral talk would be read as a dovish one, and that should be enough to send the pair higher to 1.3315 levels or so. You see, this is the 23.6% Fibonacci retracement level of the Brexit day high and the post-Brexit low. So that should be the first. That should be the first hurdle. And if we breach the hurdle on the day and closing basis, then I guess the doors would be open for a rally to 38.2% Fibonacci level over the next month, 1 month or so, which comes around 1.3641. So that's the technical outlook. On the downside, in case we do have a hawkish hint, then it's quite clear that we will be going down to the symmetrical triangle support that comes around right now around 1.2895 levels or so. So that's my take on GBP USD pair. And now we move on to dollar yen. Time and again, if you had checked the Dirty Economics website, and we have posted our views on yen, which are pretty clear that the job of lifting the dollar yen pair rests entirely on the shoulders of Fed. BOJ stands exhausted, and every other day we have a new fiscal stimulus, some kind of a fiscal stimulus in Japan, and it's Marcus doesn't really care anymore about what Bank of Japan or Japanese government do. And so, as the saying goes, what's gone up has to come down. And dollar yen rallied from like 75, 78 levels to 125.856 levels over a period of 3 or more years, from November 2012 to 2015, mid 2015. So almost 3 years. So now that the stimulus has lost its efficiency, Japanese stimulus has lost its efficiency, we are going down, and we can go all the way down to even 90 or so, unless of course Fed hikes rates, which in case the yield differential would come into play and dollar yen could once again go higher. But given that Yellen is unlikely to provide any outright hint of a rate hike, the odds are that we are heading lower to this falling channel support. The first one comes around 97.70, 97.80 levels, and the Brexit day, the post-Brexit low is around 98.78. So that's a potential target as well. The immediate support is around 99.54, which in my opinion would be taken out in one go in case Yellen is extremely dovish, or even if she is neutral. On the higher side, as I said, we need a massive we need a slight hint of slight hawkish talk. you know, for dollar yen pair, especially for yen, even a slight hawkish talk would be enough, because sentiment is extremely bullish on yen, and when the sentiment tilts to the one side, to the extremes, the reaction is usually opposite. And so other measures may not feel the heat of mildly dovish uh, uh, Yellen, but that would be enough for dollar yen pair to move higher. So above 100.71, we could go up to around August 12 high of 102.27. However, I see bullish move gathering pace only above 102.65, which is August 8 high. So once we close our 102.65, we go higher to around 104.30, 104.50, which is the falling channel resistance. Now then we go on to one of the interesting pairs is in New Zealand dollar. As we can see, we are in a small uptrend right now, and the larger rising channel has been breached on the higher side. However, if I zoom on the daily chart, I see candlesticks with large upper shadows marking a repeated failure. The first failure to sustain above 0.73 handle. The first failure is seen on August 11, and since then, we have had multiple intraday highs above 0.73. However, the day end closing on 99% of times has been below 0.73, except on August 24th, when the bird closed at 0.7308, and that was its highest day end closing since, I guess, May of 2015. And which means we have had a sort of a bullish break on day end closing. So one might think that the odds are that the pair would go higher. We have this expanding triangle, expanding channel formation, and that could act as a resistance around 0.74. However, there is one more thing that I would want you to look at, is that we have this FXCM real volume index of sorts, and now this is a real volume index, and if we see, the recent bottom stands around 0.7087, which is August 8 low, and since then we have been pretty much seeing positive candles. But look at the volume bars, they have been declining. So there's not really a strong buying interest at a time when the pair is moving higher, and that goes well with the fact that we have candles with long upper shadows, which in itself suggests a reversal may be on cards. So in case we have mildly dovish comments, mildly hawkish comments from Yellen, I guess this pair could go lower. you know Even a mildly hawkish comments could send this pair lower, simply because we have this volume divergence on the chart already. And then let's, however, note that if Fed comes out dovish or stays neutral, Yellen comes out dovish or stays neutral, uh, we are likely to see a spike higher. And watch out for the Kiwi against other European majors, because Kiwi is still the highest yielding major currency. The interest rate stands at 2%, and interest rates in most other nations except US are below 0.50%. So that's a massive yield differential. And unless and until RBNZ doesn't hint at aggressive easing plans, I guess this yield differential would continue to underpin demand for New Zealand dollar. And then we go on to the last pair, is the Aussie dollar. And I would want you to have a look at the monthly chart, and it's a very interesting one, because we have this long-term falling trend line in place. The resistance comes around 0.7788, or let's say 0.78 handle. and we could see a bullish break, which would mark a long-term trend reversal in the Aussie, in case dollar is heavily offered after the Yellen speech. So traders should look out for this month's closing in Aussie dollar. If it's above the falling trend line level, uh, that would be a time to buy the dips. Of course, if we close above the falling trend line level, that would be the third straight monthly uh, closing, a bullish closing, and that warrants a bout of profit taking. So it's advisable not to jump immediately on the long side of the trade, but wait for a bout of profit taking maybe in the first week of September or so, and then buy the dips. If you see a breach of the falling trend line, it's buy the dips trade on Aussie dollar. And the last market that I would want to look at is gold. This is similar to Aussie dollar in a sense that it's flirting. It's flirting with the long-term falling trend line resistance. We have this bullish. I wouldn't say bullish. We have this flag and pole kind of formation. This is a monthly chart, and the 2008 low stands at 681.75, and the metal topped out at 1920.94 in September 2011. Since then, we have been in downtrend. Most experts suggest that metal has bottomed out in December 2015, which makes sense given the that we are operating in a ultra low bond yield environment. There's no yield anywhere, and that's why investors prefer to pour their money into precious metal space. But if you look at the monthly chart, we are yet to see a long-term trend reversal, because the metal is stuck at exactly at the falling trend line resistance. Call it a falling trend line resistance or a flag resistance. It's one and the same. And we need a bullish monthly closing above the falling trend line, which then would suggest a long-term trend level. So that's why I just said that gold story, technical story, is similar to that of Aussie dollar. And given the strong correlation between Aussie dollar and gold, uh, a bullish break in gold should also lead to a bullish break in Aussie dollar. So both would become buy on the charts. On the other hand, the difference between Aussie dollar and gold is that Aussie dollar is still holding quite strong. It hasn't really tested the trendline resistance and failed. However, when we look at gold, it tried to take out the falling trendline resistance in the last month, failed. It attempted a bullish break this month as well, and the result was the same. It failed, and now it has actually turned lower. So when we look at gold, the signal is confusing. It tells me that we might be, markets are expecting hawkish Fed, and we might actually get hawkish statements from Yellen today. But when we look at charts like New Zealand dollar, or for that matter, even the British pound also, then you are forced to think if indeed there's a possibility of hawkish comments, or dollar is going to get sold off across the board. And that is the reason at the start of this presentation I said that there are mixed signals from the markets. Gold is suggesting broad-based dollar strength. If we also take a look at DXY, which is the dollar index, again, the chart somehow looks confusing to me, because it is suggesting me that we are forming a sort of head and shoulders pattern with neckline around 91.33. And if we switch on to the weekly time frame, once again, it's a massive engulfing bearish engulfing candle we have had. It engulfed gains seen in the previous 3 weeks, and then since then have been declining. And when we look at this chart, it tells us that dollar is going lower. when we look at the gold chart, failure at the long-term falling trend line resistance, it tells us that maybe dollar is going to get a boost. So it's confusing signals, but I would conclude by saying that uh, neutral stance or data dependent Yellen would be read as dovish, and in such a case, uh, the obvious trades are long gold, long British pound, long British pound against euro, long British pound against Aussie dollar, or for that matter, even New Zealand dollar. Why I say that is because over the last couple of weeks, New Zealand dollar has benefited from the yield differential, and if we look at the GBP NZD chart, you can check out in the GBP NZD daily chart, there is a bullish price RSI divergence, breach of falling trend line, so that becomes an attractive pair. You can straight away buy GBP USD as well. In case you have hawkish comments from Yellen, then the obvious trades are sell GBP USD, sell gold. We already have a big failure at the major trend line resistance, so that makes it a perfect sell. Sell silver, sell silver in terms of high yielding currencies. High yielding currencies are AUD, NZD. Then you can also sell emerging market currencies. Equities too are likely to come under pressure. So that's pretty much for the Yellen preview, and all the best with your trades. Have a profitable day and see you next time. Thank you.